Good day and welcome to the Kerner Perspective local portfolio commentary for the half year to the 30th of June 2024. But as we've done in the others, because of these videos are being released late, we're going to include July and maybe even more recent data than that in some of them. So starting out, we're not going to dwell on this. We did deal with it in the asset market review, but as you can see on the 1 year, for example, up to the 30th of June, all share was not great. The top 40 underperforming that really because the bigger caps didn't perform as well. Whereas you can see banks and more the local economy stocks, small caps, mid caps, industrials and listed property doing very, very nicely. That's up to the end of June. If you include July, you'll see technology and telecoms in the month of July sort of probably followed more some of the skittishness in world markets, whereas the local economy stocks in the month of July responding very favorably to the government of national unity, particularly consumer goods and banks having a good time. But as you can see, quite a mixed bag on average, with the only really disappointing performance consistently, if you look over a year, being in the telecom space. Local indices looking a little further out, taking for example the 5 year, you can see the all share up 37% in total, and that's obviously the capital move, which translates to 5 and a bit compound annual. And as we said recently, the 10-year performance is very, very similar. So really has been, like in the FTSE in the UK, almost like a lost decade and a half a decade. Yeah, and as you can see there on a 5-year view, some of the poorer performances coming from industrials, listed property, and telecoms. And on a 5-year view, banks are actually underperforming. Small caps, once again, not a great reflection of what's really happening in the small cap universe, but up strongly. Yeah, and then consumer goods obviously also strong. And as you can see there on the 3-year view, the standout performance from banks at 55% gain over 3 years. I think that's largely because of the artificial low, courtesy of the COVID scenario. Just a reminder of how the top 40 index as a benchmark has morphed. On the right is the top 10 holdings as of June 2019. You can see Naspers at 22%. BHP, Richemont and Anglo's effectively combined representing almost half the weighting, and you can see how radically that changed, where Anglo's in 2023, the middle block, suddenly became the biggest holding, followed by Naspers, FirstRand being fairly consistent, but obviously with a rejigging of the index courtesy of a few amended listings there. You can see Richemont, for example, changing, with the conversion of the depository receipt structure, basically just resulting in quite a reallocation of some of the others at the top of the pile. And then you can see as of 2024 June, Naspers at 12 and a bit percent, followed by FirstRand and Standard Bank. So yeah, banks have definitely moved it forward. Gold's is still quite a significant component. And then Richemont in large part, as I say, because of the change. So I think the only point we're wanting to make with this slide is that the underlying top 40 index is actually quite volatile, and using that as a benchmark is dangerous. And yeah, our view is always we allocate capital to assets that we believe will deliver good risk-adjusted returns. This is an example of the Kerner Perspective portfolio positioning. If you took the clients, the direct clients in our SPG portfolios, with some consideration of what would be happening elsewhere. As you can see there, the biggest holding, Standard Bank, followed by Naspers, Aspen, Shoprite also around 6%, as is ABSA, but fairly high conviction, particularly amongst some of the smaller caps, things like Argent and Ethos and CUP, all around the 4% mark. Interestingly, Foschini Group, TFG, has grown to be one of the bigger new additions. So I think the key thing here is obviously there are some smaller holdings, and part of that is because not all portfolios can look the same. We have certain clients who have appetite for certain types of assets like a Bell or an African Rainbow Capital, whereas others obviously might be a little bit more conservative, looking for bigger caps with dividend yields. So this at least gives an idea of the assets we hold, and as you can see, quite differently structured to the top 40 index. With quite significantly underweight positions in Naspers, very overweight in Standard Bank, no Goldfields, no MTN, and very small holdings in FirstRand, as we've really consolidated more recently our holdings in banks in what we see to be the cheaper of the banks. Speaking of which, why we're so overweight banks, this takes the 18-year price earnings multiple on the JSE Banking Index over time. As you can see, it averages around 12 times if you look on a trailing. You can see the current historic PE, around the 10. Obviously, that's being inflated by a couple like Capitec. But interestingly, as the results come out, we've seen good results out of the likes of Standard Bank. That is going to dilute that PE. So ironically, we're seeing pretty decent earnings growth coming out of the big banks, with the exception of ABSA, and yet trading on quite significant discounts to the long run PEs. All right, then going into the holdings kind of in terms of the way it's reflected in our average portfolio, starting with Standard Bank. From that ridiculous sell-off courtesy of COVID, it's probably about a 45-degree line, but as you can see, if you go back 10 years, from a level of around 150, hasn't been a great performer, but a very, very good performance from, say, early 2020. Standard Bank gave us results late last week, and I suppose it's one blessing of releasing this video late, but on the left-hand side is really the base case hypothesis for investing in Standard Bank. The blue bar there being the earnings per share, with the last three being forecasts, although we feel there's reasonably good visibility on the FY24 numbers. But as you can see, a nice steady trend upwards. A couple of the headline numbers there, headline earnings per share, 13 Rand 29. So, we're on track for 26, 27 Rands worth of earnings. Return on equity very decent at 18.5%. Dividend yield of 7 Rand 44 translates into a divi yield of around 7%. And common equity tier 1 ratio at 13.5%. So all looking very, very good. Kind of steady as she goes in Standard Bank. Moving on to Naspers, and we're really just going to touch on one or two things that we believe was more salient in some of the bigger holdings. Naspers obviously has been quite volatile in the last while, I think in large part driven by weakness in China and in Hong Kong, and anxiety around clampdowns, and more recently maybe anxiety around tech ratings. So, Naspers is probably pretty much where it was at the beginning of 2021, and not that different from where it was, shortly after the COVID rebound. But still, on a 10-year view, it's done well. Just having a quick look at really the investment hypothesis for us. It's got two parts. The first one is the discount to net asset value. You can see there that with an implied net asset value in Rand terms of just under 6,200 Rand, with the current share price at around 3,600 Rand, gives you a discount to net asset value of around 40%. I think the other thing that's quite important for us is it's not just a bet on NAV, because if the NAV is vaporous, it's a bit silly to be chasing it. We feel that Tencent is on the mend. The top one is the share price graph. You can see it has started to recover, but more importantly, we expect quite a kick up in earnings in this year, and then for the momentum to continue, as you can see in the bottom chart, and the dividends also looking better. So Tencent is growing up, and we do believe that China has a vested interest in seeing a successful technology sector. All right. ABSA's obviously been disappointing. If you look over a 10-year view, share price pretty much the same. I think the one important number here is you've got a net asset value of around 170 Rand per share. Sorry, a share price of around 165 or so after a little bit of a rally yesterday after the results weren't quite as bad as expected. If you look at the NAV around 170 and the tangible NAV of about 152. So bottom line is shares trading at or slightly below net asset value and only slightly above tangible NAV. We think that ABSA has done a lot of good stuff over the last few years in transforming its business model. You can see there on the left, the African region is now contributing 29% of the net, and the CIB contribution is at 32. So, you know, these are obviously comparative to 2018, so that's a 5-year period. But if you go back a decade, that transformation is even more significant. And I think the important thing is, you know, they were growing the revenue while the cost to income ratio was declining. You can see their net customer loans at the top. Definitely more growth in CIB, for example, over the last few years relative to, say, the product cluster, or everyday banking, where growth has been quite muted. And a similar sort of story on the deposits, where by quite some way CIB is now the biggest source of deposits. The H1 results, when you look at that share price graph a few days ago, ABSA put out or a couple of weeks ago, put out a trading, or let's say profit warning, indicating that the earnings were going to disappoint. Share price obviously got hammered quite hard into the early 150s. And then after the results earlier in the last few days, you've seen quite a rebound in the share price. And I think part of that is really just around the fact that, some of the story that was coming out was good. There you can see the revised June NAV was slightly up on 170, in fact. And you can see that generally the spending, if you look at that bottom right block, you can see technology spend was up 14% in the half year, and marketing also up 17%. Arguably, that is good spending. So that's the kind of stuff that puts assets on the balance sheet and generates future income. The top right block is the earnings per share and dividends per share. And I think that's for us the investment hypothesis here. Obviously, FY24 is going to be disappointing, so probably earnings very much flat on 23. But still, the trend line is intact, and we would expect a very nice recovery in 25 as interest rates come down, because obviously they are probably more exposed to the mass market and the broader middle income market than quite a few of the other banks. So, we see the steady upward trend in earnings, but the share price disappointing over a 10-year view, actually basically anchoring the investment case. And then this really just puts that all in context. This is the ABSA historic PE, and you can see, especially if you consider that chart we showed earlier about the average PEs, ABSA is trading at a very deep discount to its historic PE ratio. All right, moving on to Aspen. This is a little misleading because, we haven't held the share. In fact, quite a few of these we haven't held for 10 years. So you kind of have to recalibrate to the starting point. We probably started in 2018 around the 250, 270 mark. It's gratifying to see Aspen fighting its way back, and pretty much consistently through COVID into 2022. Obviously, there's quite a lot of excitement, but that seems to have settled back. But ABSA's performance is not too different from what we've seen from the global pharma companies. Just one or two slides on them. You can see if you look at the manufacturing business showed quite a nice turnaround in H1 24, as did OTC, with injectables being quite disappointing. But all in all, revenue up 10%, and in constant exchange rates up 2%. So, we've always said that Aspen, with about 3/4 of their business outside of South Africa, is kind of the forgotten rand hedge. And for us, I think, it's a business that's really well placed, be it the plant in Quebec or, the operations into China, or the opportunity to sell more into the US. Lots of optionality here. And really, this slide just talks to the fact that H2 is going to be an inflection point, and really the key there is to see better capacity utilization from the capacity that they've built, and really in large part have spent huge amounts of money, time and energy on, and we believe will now start generating a return, with maybe some surprising returns. I think Aspen for us is, you can see that earnings trend line has been disappointing over the last 8 or 10 years. And part of that is obviously they were too acquisitive, had to offload because the excess debt, kind of almost repivoting the business. You can see FY24 is not going to be spectacular, quite similar to 23 and 22, but we would then expect to see the benefits of the investments and the business model. So although that earnings growth trajectory has been somewhat disappointing, even in rand terms, we see Aspen as offering pretty good odds on giving you solid inflation beating earnings and dividend growth in hard currency terms, and we think the next 2 or 3 years are probably going to be very good for them. The Reinet, I think we've mentioned this before. Reinet was our preferred entry point into British American Tobacco. Our BAT holdings we've sort of trimmed in most client portfolios, and in new portfolios haven't had them ever. And you can see, Reinet did very little for a very long time, up to sort of from the 2014 up to 2023, almost flat, but more recently has taken off, and that obviously in large part driven by the Pension Insurance Corporation. But more recently, we've seen British American Tobacco itself kick into gear. Although that is an ever shrinking component in that NAV, at least we believe on the short term will probably give it a little bit of impetus. Then Foschini Group, this is a little bit misleading. If you look at Foschini in the mid 130s, in fact yesterday closing I think in the late 130s, you've seen a very, very nice recovery from 2020. Generally our entry point was probably on average around 100 Rand, maybe slightly less than that. So very, very gratifying to see the results kicking up. I think partly on the GNU, also good execution from management. And as we said in our previous edition of the local portfolio, a business we like, we said it was solid business with attitude. So we're very, very pleased to see the strong performance from Foschini Group. And as we said, it has grown to be quite a significant holding, where it was pretty much non-existent in portfolios not long ago. Then Ethos Capital, we have to be honest, has been one of the perpetual disappointments. This share price, obviously, currently sitting at about 4, has been adjusted for the Brait distribution. We are very comfortable with the residue of the NAV. We get an NAV of around 8 Rand a share, and some very, very good assets in there. So management and the board have resolved to effectively realize value and return capital to shareholders, which is in some ways sad, but for us this really is a slam dunk investment. And you can also see liquidity very, very light, kind of as the existing holders seem to be stronger and stronger, and everybody seemingly supportive of the idea of the new strategy, albeit somewhat of a tragedy for listed private equity. All right, Shoprite has been a phenomenal story. You could see it was sitting at 6% of a lot of client portfolios. We haven't bought it for some time, and the real reason for that is that if you look at the earnings growth rates. If you look at that trajectory, very solid. I mean, tracking the trend line very, very nicely. But for us, it's kind of, if you look, if you take the current financial year, which is really 24, which we're just waiting for, and 25 and 26, you basically would say that that's around 10% a year compound earnings growth, whereas you're sitting with a trailing PE, if you take to June of 24, of about 24 times. So the PEG ratio is just ridiculous for us. Great business, but share price is over the top, and that's the reason why we have trimmed back in quite a few portfolios over a season. Remgro more recently been a little bit disappointing. I think some concerns around the spirits portfolio, the Heineken JV, but it's had a good run from its lows in after COVID, and still a good underlying portfolio. But you kind of get the feeling now we need the really good news to start flowing, be it at Mediclinic or some of the other private equity type plays. CUP has been disappointing, but we remain adamant that the hypothesis is strong. They came out with a trading update a couple of days ago indicating earnings, call it headline earnings, around 45 cents. You know, if you consider this as a share that's trading at around 3 Rand, if you put it on a 10 multiple at 45 cents, which is pretty similar to the past, then you know you're getting a business that's probably comfortably worth 4.50 Rand trading at 3 Rand. So we see quite a lot of upside, and the hypothesis is in place. And I think a big part of that is, you know, good underlying portfolio, very, very careful capital allocation, evidenced by the fact that the Unitrans asset is being reviewed, and also quite a lot of capex that is yet to generate a contribution. And it doesn't matter whether it's, you know, PV plants or, you know, the fiberboard plant at PG Bison. We think there's some good news to come out of this one and remain very confident. Then we're going to do a slightly deeper delve into African Rainbow Capital. We don't hold them in very many client portfolios. Reason being, you know, when you've got things like Argent as an NAV play, excuse me, and Ethos, you know, and a couple of other sort of smaller kind of companies, we also don't want to concentrate too much. But we're also seeing an opportunity in African Rainbow Capital in the listed private equity participation space. You can see there share price around 6 Rand, well down on where it was, you know, when it first came into the market. And we believe this is a good bet. There, if you look at the portfolio, they basically, as we've discussed before, they've broken the portfolio into what they call diversified investments, which is things like telecoms in the form of Rain, and obviously the business process outsourcing. So that's you know, a whole lot of mixed bag of businesses with some diversified financials, and then they've got a financial services portfolio, which is kind of the stuff that they are more operationally sort of hands off on. The big one there, of course, being TymeBank. So, you know, a chart like this is a bit confusing. So what we did was we actually looked at the net asset value per underlying asset, rather than sort of trying to break it into diversified investments and financial services. So this is kind of just taking a helicopter view and looking at the portfolio. Effectively, Rain represents about 27% of NAV. TymeBank represents about 22%. You've got some other interesting businesses in there as well. You know, Crops is a business we like, which is obviously in agricultural commodities, 11%. Sanlam Third Party Asset Management, another interesting one, as are businesses like BlueSpec, which is obviously interesting from a point of view of being almost a competitor to We Buy Cars. That has created a lot of excitement. And then Alex Forbes itself, and then you can see some of the smaller holdings, regardless of whether they fall technically into the financial services bucket or the diversified investments bucket, some fairly small assets, and as we've indicated before, management, the two Johans as we call them, have said that on their to-do list is really to cull the number of investments and to focus more. So, some people might have a concern about the RAIN valuation. It's obviously quite significant. We believe that while telecoms is going through a very difficult phase, we think that RAIN is somewhat the Caesar who is effectively rewriting the rules at the expense of the traditional network operators, Vodacom and MTN particularly. But we think it's a decent business. But what we're really excited about is time, and that's obviously got a holding via the diversified investments, but also in financial services, 22% of NAV, very exciting. So I think the important thing for us is this asset is trading at about half its net asset value. Even if you took a haircut on things like the valuation for RAIN and a couple of the others, there's a lot of optionality here, including businesses like Crossfin, and some of the other fintech type of businesses. So we like the portfolio generally. We think that portfolio is going to do well, and we can't see a reason why this should trade at a 50% discount to NAV. Then Argent, we discussed in a little bit more detail in the last while, and basically how it was the poster child for value investing. Where the earnings that they delivered recently were basically the same as the share price of let's say 6 or 7 years ago. It's gapped up, probably still has value if you look at the NAV, but we think it's kind of done its thing for now, so we are not going to chase it. BHP, along with the commodity stocks, has come off quite nicely. We're seeing a little bit of value in BHP, and it'll probably be the first of the commodity stocks to add to client portfolios, and there's quite a few of them that have little or no commodity exposure. And the hypothesis there is just around holding the right assets and also being in very low cost producing assets. So we quite like the recent weakness in BHP as an opportunity to add the share. York Timber has gapped up of late. Obviously, they're still in the process of working through that strategic decision, which was backed by the rights issue to lengthen the harvesting period of the trees. You get the sense that people in the know are seeing value, and we would agree with that. The NAV is probably give or take 4 times the current share price, so we are confident with the underlying. Bell is not a company we hold in a lot of client portfolios. We hold quite a lot of them in the fund. In fact, it was, as we'll disclose in our fund commentary, after the takeout offer by Bell and Company, the family, it was our biggest holding in the fund, which was quite strange. But again, sort of eventually value will be unlocked, but obviously quite a bit sooner than we expected. A few clients hold them, but the liquidity was just very, very low, and it's almost impossible to get holdings for many investors. City Lodge, we haven't been there for 10 years, so that chart is a little bit misleading, but obviously COVID wreaked havoc with the business, but it also caused a massive dilution because of the needs to do a rights issue to bring the debt down at a very awkward time. But we're very comfortable with the underlying operations. We think that they are refocused, and there's good energy coming through, particularly from the food and beverage offering. So we're very comfortable with the investment case for City Lodge, particularly because you get the feeling that inbound tourism is also benefiting City Lodge. Then Prosus, we've said for a long time, we actually preferred Naspers, and I think this chart proves that. So, the Prosus we hold was really just essentially what we got with the corporate restructuring, and we never exchanged Naspers for Prosus, and generally have done just retained our holdings. All right, then just a quick word or two on some of the other smaller holdings in the portfolio. Richemont, which sounds crazy, a business of this stature, This is, since the restructure, it's obviously been under a little bit of pressure, but still good, strong underlying portfolio, strong cash flow. But I think increasingly some worries about some of the regions, and particularly the impact of disposable income. So Richemont we don't think is going to hurt you, but if you look at the earnings over time, they're quite volatile, and we think we may be going into a slightly softer period. So generally I think a little bit of circumspection is probably necessary on the valuations of the luxury goods plays, but we would argue that if you have to pay a premium, this is probably the one to pay the premium for, simply because of the nature of the business model. Investec, like the other banks, has done very well, but outperformed generally, in large part because the previous 5 years was just such an abysmal period. But definitely the new model and the new management is working very, very nicely. But also not a share we hold a lot of, but it is in a couple of portfolios as a top up to Standard Bank and ABSA, or Standard Bank and FirstRand. Coronation, this chart doesn't really tell the story. We added some to client portfolios and actually have a fair holding in the fund, really around the expectation that local markets would perform well. We understand the pressure on the big managers to grow the asset base, but the reality is that the market growth alone could actually compensate for that. And we were fortunate in that their appeal to the Constitutional Court for the tax judgment against them was successful. So effectively a really nice special is going to come out. So Coronation and 91 for that matter are really just geared market players, which is kind of more a tactical bet than anything else. New World Holdings, very, very illiquid, in fact even more illiquid than Bell. We like the story. We think if you look at the cash underpin, it's equal to, or in fact exceeds, the current share price. They've got some good offshore operations. If you strip South Africa out, even if you sort of shut South Africa theoretically, and you looked at the offshore operations, those offshore operations themselves aren't on a demanding multiple. So we think New World is probably going to go the route of Bell, and that sooner or later, the family will take it out. 91, similar sort of story to Coronation, arguably a better global footprint. Obviously their AUM was under pressure as capital was withdrawn from growth kind of mandates, but we believe that will also turn, and it's a well-run shop. So kind of either 91 or Coronation, you can actually pick. They've each got obviously their own merits and disadvantages. Mondi is a very nominal holding. We've got a few in the fund and a couple in client portfolio, some of which is legacy. We like the story very much. There was a little bit of weakness after the last result. We see that probably as an opportunity, although we see value sort of closer to 330 Rand a share. So you never know, maybe the Rand fighting back, went through 1780 a day ago, may actually give us that opportunity. But Mondi is definitely a business that we like. Wilson Bailey Homes, largely in a lot of legacy portfolios. We did buy some in the fund. I think growing sense that South Africa under the GNU needs to build stuff, and they're one of the few, which was our investment case, one of the few organizations with the capacity and the reputation and the skills to help build the critical infrastructure. Then Old Mutual's been disappointing. Kind of a bit of a geared market play, but also we like some of the noises. They've obviously gone and established a bank. We'll see how that plays out, but really, trading at a fairly significant value to what we would consider to be intrinsic value. So it's really just kind of a discount to fair value play. Sasol, that just remains perennially disappointing. Fair value is probably 300 Rand. The question, though, is whether we're ever going to get close to that. So, it does feel as though Sasol seems to have set into a new paradigm. And with oil at around 80 or a little less, and the rand looking a little bit better, it's difficult to actually see a scenario in which it gaps up to 300. But for now, it's very much earmarked for sale if we can get the right price. And then just very quickly on the preference shares, ABSA prefs have gone a little bit higher. Nice thing here, of course, is you're getting almost prime. Of course, there's some dividend withholding tax leakage for those that would be subject to DWT. But we're seeing very, very good yields, and not quite 100%. So when prime comes down by 100 basis points, you don't experience the full write down. And then Standard Bank prefs a similar sort of picture. So that really concludes the local portfolio commentary. We hope this was of value, and as always, we welcome your feedback, be it positive or negative. We thank you for your time.